Japan is doing what only a few years ago seemed unthinkable. The country is beginning a full-scale exit from United States government debt, a process that for a long time unfolded slowly and almost invisibly, is now turning into a strategic course that is changing the balance of the global financial architecture. And if earlier it was China that was considered the main systemic risk for U.S. Treasuries, now another name is increasingly being heard: Sanai Takai, the new Prime Minister of Japan, under whose leadership Tokyo, for the first time in decades, is turning its financial strategy toward freeing itself from dollar dependence. According to several sources from the Japanese publication Nikkei Asia, in closed cabinet discussions, Takai's course was articulated directly. Japan can no longer afford to keep its economic security in the hands of Washington. Diversification of reserves is a matter of national survival. After she came to power, Tokyo's rhetoric changed sharply. If previous governments viewed U.S. debt as an instrument of stability, today the expert community increasingly argues that treasuries have become a source of vulnerability. With the growth of United States debt, which has already exceeded 37 trillion United States dollars, and with the wave of tariff decisions by the new administration of Donald Trump, Japan suddenly found itself in a situation where it has to choose between its habitual attachment to the dollar and its own financial independence. And judging by the dynamics of recent months, the choice has been made definitively. The first serious signs of the pivot appeared as early as the beginning of the year 2025, when data from the Japanese Ministry of Finance showed for the first time a sharp surge in sales of foreign bonds, more than 20 billion US dollars in just 1 month. At first, this seemed like a temporary movement by major funds or a reaction to market volatility. But further publications by Reuters and Bloomberg confirmed that the sales concerned U.S. Treasuries, and analysts at Goldman Sachs called this the first systemic signal that Japan is no longer a passive holder of United States debt. With Takaichi's arrival, this trend became a strategy. According to the Financial Times, citing sources in the Japanese Ministry of Finance, the new administration plans to reduce its treasuries portfolio by tens of billions of dollars annually, until Japan's share falls below the level that makes it the largest foreign creditor of the U.S. For Washington, this turn came as a surprise. For decades, Japan had been the main stabilizer of demand for treasuries, and many American economists viewed it as a quiet partner in financing the national debt. But everything changed after the Donald Trump administration announced a new package of tariffs against Japan, citing unfair trade practices in the automotive industry. Insiders from Kyoto News, familiar with the situation, confirmed that the shock in Tokyo was so strong that on the very same day, the financial wing of the government discussed whether it made sense to remain the largest holder of U.S. obligations in conditions where Washington is willing to strike Japan's economy without warning. As one former advisor to the Ministry of Finance noted, it was Trump's tariffs that became the moment when Tokyo realized that United States bonds were no longer equal to security. From that moment, sales have only accelerated. In reports from international banks, the expression "Japan unwind" appears more and more often, denoting the systematic reduction of Japanese investments in U.S. debt. As recently as the year 2024, Japan's portfolio exceeded $1 trillion, but already by the middle of the year 2025, according to the Congressional Research Service, it had fallen so much that analysts began to speak of the risk of losing full holder status, meaning a country capable of influencing the Treasuries market with its purchases and sales. If the current pace continues for only 1 or 2 more years, Japan will cease to play a key role in the American debt market, and this will become the largest geo-economic shift since the early 2000s. Japan is leaving so rapidly for one reason: the realization that the dollar has stopped being a guarantee. In Takaichi's government, the phrase unacceptable dependence is heard more and more often, and the National Financial Security Council recommends reducing the share of dollar assets in favor of gold, the euro, the pound, and even Chinese yuan. In one of the closed reports referenced by Nick Shimun, it is stated directly that if the United States continues to use tariffs and financial instruments as a tool of pressure, dependence on treasuries may become a threat. At the same time, Tokyo is accelerating gold purchases. According to the Bank of Japan, in recent months, the volume of gold reserves has reached a new record, and several influential members of the ruling party openly call gold insurance against American unpredictability. Japanese funds simultaneously increase positions in European bonds and currencies, and major corporations are converting part of their dollar assets into the euro and the franc, fearing that Washington may one day repeat a freeze scenario similar to what it used against Russia in the year 2022. Experts interviewed by The Economist warned that if Japan truly continues exiting treasuries at this pace, the United States bond market will face pressure similar to a confidence crisis. Even now, yields at U.S. Treasury auctions are rising, as sellers must offer higher interest rates to compensate for the decline in foreign demand. And analysts note that one of the key factors is precisely Japan's portfolio reduction. In addition, Japan's exit worsens the trend that began because of China. China has been reducing its treasuries holdings for many years, and now Japan's shift doubles the effect. If earlier the U.S. could rely on at least one of the Asian giants, now both largest creditors are simultaneously reducing their dependence on United States debt. Worse for Washington is that this process is irreversible. As an analytical report from Oxford Economics notes, Japan will not return to previous levels of treasuries ownership, even in the event of political warming. Japan's security system is now built differently, and a Nick insider adds that this is not a gesture against the United States. It is an attempt to save Japan if America ever decides to strike even harder with tariffs. This is how a new reality takes shape. The world in which Japanese banks and state funds automatically supported American debt is fading into the past. And if the trend continues, global markets will, for the first time in half a century, face a world where the United States can't count on unconditional support from its largest creditors. But the deeper the world moves into this new geoeconomic reality, the more obvious it becomes that what Japan is doing is not an exception, but part of a much larger process. Several countries that once seemed reliable pillars of the dollar system are beginning to think the same way, and Tokyo's initiative only highlights what is already happening in the shadows of global markets. According to the IMF Financial Stability Review, more than 10 major holders of U.S. government bonds, including South Korea, Singapore, Saudi Arabia, and even several European central banks, have since the end of 2024 slowly but noticeably begun to reduce the share of dollar-denominated assets in their reserves. Formally, this is explained by portfolio optimization, but analysts at Morgan Stanley point to something else. Countries fear a repeat of scenarios in which Washington uses financial instruments as a political weapon. In parallel, the BRICS group is creating its own settlement system, discussing a unified digital asset, and increasingly advocating global trade without the dollar. This process is moving slowly, but the direction is clear. The farther it goes, the less the world needs U.S. treasuries as a safe asset. The U.S. national debt is growing faster than at any previous time in the country's history. Expenditures exceed revenues by several $trillions. Interest rates remain high, and the cost of servicing the national debt is approaching $1 trillion per year. And all this is happening at the moment when foreign demand for U.S. treasuries is beginning to thin out. As a Bank of America economist noted, the U.S. has reached the point where demand is no longer guaranteed. For the first time in 40 years, the market is not sure that anyone is ready to catch America if it falls. And then the main question becomes inevitable. If Japan and China no longer keep America afloat, who will fill this gigantic gap in financing the U.S. public debt?